Tech is in the eye of the storm today. Just what's your broad view on what we're witnessing?
Yeah, so I think the big story here is what's going on in the rates market. And the reason why it's important is that today inflation break-evens are actually lower, meaning the market thinks the outlook for inflation is actually lower. And there's been very little change in Fed expectations. So the entire move higher in yields is all real yields moving higher. And they're moving higher because of this deficit and debt issue that we had. So, the market has and the economy has absolutely benefited from the deficit. We've talked about this for a long time. We're running a $2 trillion deficit, and that has been a stimulus. But if it was that easy just to run a large stimulus, then of course, or a large deficit, there's obviously a downside, and we're starting to finally see that downside. And that's what's happening with yields moving higher. So, you're seeing it across sectors, and, we've seen the financial situation show up back in February, March. We've now seen the utility situation show up as of, last week, and we've seen a lot of pain in that sector. And what you can see is that it's rolling through different sectors because higher rates not only impact the consumer and will continue to, but also corporations.
Yeah, I mean, I said these discretionary stocks today, hotels, casinos, restaurants, all these sensitive areas. So are you suggesting that as long as this move in rates continues to be at the forefront, that stocks just are not going to be able to do anything but go down?
Yeah, it's going to be really tough for stocks to work as long as yields are in this zone. For a couple of reasons. It's not only the headwinds from, corporate interest expense, which we're seeing, real time, but it's also looking at valuations, right? It's looking at the alternatives. And what's important is that the reason why yields are moving higher, one of the big reasons is that the government net issuance of treasuries is going to be about $800+ billion this quarter. That number was less than 400 1 year ago. And so capital has to come from somewhere in order to absorb that supply. And it's unlikely to come from our international friends. It's going to really have to come from much more domestic, and that's really going to pull capital from other places. So I will say that, yields right now, bonds are very oversold. So there is a possibility of a reversion. But I think the trend is in place that we're going to have higher yields for longer.
Yeah, we're approaching, just lastly before I let you go, we are approaching some interesting levels, Eric, on the S&P, 22, 23 points away from that 4,200 line, which may be a critical level to keep your eye on.
Absolutely. Very important level. Near the 200-day, the S&P RSI is 28, so we are oversold. And then, of course, people are still hoping for the fourth quarter seasonal bounce in the back of their mind. So I think we are, susceptible to a potential, reversion bounce. But I think the trend, I firmly believe the trend is still lower.
All right, Eric, I appreciate you coming to the phone for us.